If you're starting to do some research on mortgages and how they work, I think this is a great place to start. I'm going to break down what is your down payment, your loan amount, and how those two things work together for your monthly payment. My name's Jordan. I'm a licensed mortgage advisor. I hope this video helps. Starting with your down payment, I don't want you to worry too much about the different loan programs that are on the screen. Conventional, FHA, USDA, and VA. I'll have separate videos that explain those more later on, but for right now, just understand that each of these different loan programs have different minimum down payment requirements. Conventional loans typically require a 5% down payment, but if you're a first-time home buyer, you can usually qualify for a 3% down payment program. FHA loans require a 3.5% down payment, and USDA and VA loans are both government loans that have 0% down payment programs. When you're buying a house, your down payment plus your mortgage amount or your loan amount are going to add up to the purchase price. So for this example, I used a $400,000 purchase price. If you're using a 3% down payment program, then your down payment would be $12,000 and your loan amount would be $388,000. With FHA, your 3.5% down payment would be $14,000, leaving you with a loan amount of $386,000. And those USDA and VA loans, the 0% down payment programs, would leave you with a base loan amount of $400,000. Something to keep in mind is that with FHA, USDA, and VA loans, they all have options where you can finance some of your closing costs or other fees into the loan. So this page shows your base loan amount, but you can choose to have a higher loan amount with financing some of the closing costs. What I want you to understand here is that your monthly payment depends on your loan amount when you end up buying the house. So here in this example, the loan amounts are different because of higher down payment percentages. If you have a 5% down payment or $20,000 for this example, your loan amount would be $380,000. If you saved up for 20% down or $80,000, then your loan amount is going to be $320,000. But you're not stuck to any of these percentages. You can have as high of a down payment as you can afford at the time. Say you owned a house previously and you sold that house, all the proceeds from selling that house, you can roll into your down payment for buying the next one. So if you had $200,000 from selling your previous house, you could have a $200,000 down payment on your next one, which for this example would leave you a $200,000 loan amount. So what actually goes into your monthly payment? We typically look at 4 different areas: principal, interest, taxes, and insurance, or PITI. You might also see PITIA, with the A being association dues if your house has a homeowners association or an HOA. Principal is the amount that goes towards paying down your loan amount each month. Interest is your payment to the lender, and it's based on your interest rate. It's essentially the cost of borrowing money from the lender for buying a home. Taxes refer to your property taxes. Those things go to the county or other municipalities, and they go towards things like education and public safety, other infrastructure, and things like that. With insurance, I'm going to talk about 2 different areas. The main one being homeowners insurance. A good way to think about your homeowners insurance is the same as car insurance. If you have car insurance and you get into a car accident, then your car insurance company will pay you for the damages to your car. Homeowners insurance works the same way. If your house was damaged by a flood or a fire or something like that, then your homeowner's insurance would pay you for the damages of the house. So using that same $400,000 purchase price, I wanted to give you an example of what a monthly payment would look like. So like I said, purchase price of $400,000. I used a 10% down payment, so $40,000, and that leaves you with a loan amount of $360,000. I used an interest rate of 6.5% just for an example in this video. And APR is something that I'm going to explain later on in a different video. But for right now, just understand that your interest rate, the 6.5% in this example, is what you're paying the interest on. The APR is just a different measure of fees and things. Principal and interest for this example, the payment that's going to the lender, would be $2,275 a month. Property taxes, these vary by state, and some states have higher property taxes than others. For this example, I used $120 a month, and homeowners insurance works the same way of how it varies by state. It might be higher if you're in a state with more natural disasters like Florida with hurricanes. But for this example, I used $150 a month. That we have a 10% down payment here. With less than 20% down, we're going to be paying private mortgage insurance. And for conventional loans, it varies based on your down payment and your credit score. For this example, you're using $80 a month. And HOAs, not every home has an HOA. You're more than likely to have one in a condo or other types of properties. For this example, I used $50 a month. With all these together, we have a total monthly payment of $2,675. I hope this quick breakdown of down payment, loan amount, and monthly payment helped you feel more confident when you're understanding what a mortgage is. I hope you stick around and watch some of the other videos, and I'll see you in the next one.